Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a look at a different issue from the investment landscape and attempt to draw conclusions based upon the teachings of the father of the craft, teacher and mentor to Warren Buffett no less. We're of course talking about Benjamin Graham. In this episode, we should be taking a journey back in time to look at one of the darkest periods in stock market history, the event widely known as Black Monday. We should be examining the lead up to one of the biggest stock market crashes in history, as well as considering its aftermath, whilst attempting to draw lessons from it along the way. For as the great Santayana once said, those who cannot remember the past are condemned to repeat it. So let's get right down to it. As ever, sit back, strap in, and get ready to take on board another lesson in value investment as inspired by Benjamin Graham. The day of Monday, October the 19th, 1987, will likely be etched into the mind of investors for time immemorial. The day known to history as Black Monday was an event on the stock market of such magnitude that you would find few at the time unconvinced that the world was not on the precipice of another Great Depression. The weeks leading up to the Black Monday event had felt pretty much like any other. The stock market buoyed by a strong 5-year period of rising prices. But this was to prove to be the calm before the storm. Over this 5-year bull run, the Dow Jones Industrial average had risen by around 250%. And of course, investors, being investors, were giddy with excitement over their newfound fortunes, seeing no end in sight for these good times. No price being too high to pay for a stock that would surely keep on doubling in value no matter what. We were, as we often are, living in a post-value world. For who cares what the underlying value of a business is, if there will always be a long queue of investors willing to pay an even higher price. There will always be a greater fool ready and on hand to step in to buy your stock. That is, until there isn't. And as is often the case, few notice the tinderbox conditions that were starting to ferment in the markets. And there are never a shortage of sparks on hand with the potential to leave behind only scorched earth. The initial spark in this case was, in the grand scheme of things, something of a banality. 5 days before everything really kicked off, the US dollar had started to come under some pressure as a result of a new bill reducing tax benefits related to mergers and acquisitions. As well as this, unexpectedly large trade deficit figures were also announced on the same day. This was certainly not earth-shattering stuff, but it was enough to send jitters through the financial markets. And stocks on the Dow Jones slumped by around 4%, and another 2% or so the following day. The next day, the Friday before the stock market would close for the weekend, this slump was turning into something of a rout, with the Dow Jones on that day down by a further 4.6%. Now, a weekend can feel like an awful long time for investors who have just seen a good portion of the value of their portfolio wiped out over the course of just a few days. And the jitters and sleepless nights were to lead the investment community to come up with an absolute genius plan. What they would do to extricate themselves from this awful situation would be to, first thing Monday morning, before anyone else has the same bright idea, sell out of all their positions and stem their losses. And this is exactly what they did. Even before the market opened on Monday morning, the pent-up pressure to sell was obvious enough. And when the markets finally did open, inevitably, there was a huge imbalance between those wishing to buy and those wishing to sell. And as the stock market works on a supply and demand basis, this pushed stock prices down further and further. Incredibly, the Dow Jones would go on to fall by almost 23% on Black Monday. And a similar situation was developing in stock markets across the globe. For when the US sneezes, the rest of the world catches a cold. This was starting to look and feel like a big problem, not just for general investors who saw their portfolio values evaporate, but for the entire financial system more generally. The first thing to understand is that an awful lot of money invested in the stock market is money that has been borrowed. It doesn't belong to the person actually investing it. Oftentimes, investment institutions such as brokerage houses will borrow money at comparatively low rates of interest from the banks and invest this money into the stock market, in the expectation that they will be able to achieve a higher rate of return above the interest they will have to pay to service that loan. This is called margin investing, and it essentially allows institutions such as brokerage houses to profit from money that isn't even their own and leverage the returns on their investments. Under normal circumstances, sometimes this can work out pretty well for them, as over time you'd expect the rates of return from investment in stocks to be far in excess of the rate of interest they'll have to pay on the money loaned. But these loans typically come with a pretty important caveat. At any point, the banks can demand that these loans are repaid. Now, given the banks would have been just as disturbed as everybody else by the worrying developments on the stock markets, it would be more than could be expected of them not to do just this. They wanted their money back and they wanted it now. The problem was that many, because of the way events were unfolding, simply didn't have the cash on hand to return it. And this meant that these institutions faced collapse. And if they collapsed in high enough number, this could lead the lenders, the banks, to collapse with them. And when this happens, it risks the entire financial system going into meltdown. So it's pretty clear that that particular Monday was a pretty stressful one for all involved. For individual investors who were suddenly that much poorer, for institutional investors who were being asked to repay loans when they didn't have the means to do so, for the banks and lending institutions who were trying and failing to claw back their clients' money, and for the governments who were probably starting to worry about the prospect of rioting on the streets if things developed in such a way that people were unable to withdraw their money they had entrusted with the banks. So up stepped the Federal Reserve, the United States central banking system, and the body set up to be the lender of last resort in the event of a crisis. Here it gets slightly technical, but in essence they agreed to pump in billions of dollars to support the financial system, and to persuade the banks to lend to securities businesses. The action undertaken by the Fed did successfully calm the tattered nerves of the banking institutions, giving them the confidence and ability needed to support the brokerage houses in their hour of need. The Dow began to stabilise and most had made back their losses by 1990. So what can we take away from the tumultuous events of that particular Monday in 1987? The first thing to say is that 5-year bull market preceding Black Monday followed a similar pattern to many of the bull markets we've seen both prior and since. That is a sustained period of market gains over a number of years, followed by a sudden crash. Bull markets, in actual fact, rarely end with a whimper. Much more often, they end with a dramatic finale and we see plummeting stock prices. The problem we face is that nobody can be quite sure when things will go pop exactly. And as we witnessed with the Black Monday event, the trigger for collapse and mass panic can be some pretty banal and routine news. The risks for the investor around events like these are numerous. Many of the risks, you won't be surprised to hear, are psychological in nature. At such times, people are prone to believe that their stocks are heading to zero. And if you were to truly believe this, then the obvious course of action is to sell out at the nearest opportunity, regardless of how low the stock has gone. But in doing so, they turn paper losses into very real ones. The importance of staying calm and not selling out during events like these is manifest. Events like Black Monday happen from time to time, and if the investor can prepare themselves mentally, they stand a much greater chance of acting intelligently when the time does come. The next risk is related to the use of borrowed money to purchase stocks. Just as institutions are able to use borrowed money to purchase stocks, so can individual investors. Nowadays, this can take the form of CFDs, or contracts for difference, forex trading, or spread betting, where institutions sometimes allow people to leverage their investment by as much as 20 times or more. The customer needing to provide only $100 to receive a $2,000 loan to, in inverted commas, invest. If things go exactly as planned, it is quite obvious that this would magnify any profits substantially. But in the event of something like Black Monday, losses can be unlimited. And this form of investment will not give you the time needed for things to settle down and return to normal. You will be on the hook for these losses straight away. In this case, not only could the value of your stock portfolio be reduced to rubble, but you could also potentially be on the hook to lose your house, your car, the very shirt off your back. And you won't have to look far to find gurus who promote these forms of highly speculative investments as an easy and quick route to get rich. These folks, as far as I can tell, all have one thing in common. Give them an enema and you could post them home in an envelope. Watch out for them. The good news is that all the main risks associated with events like Black Monday should be easily avoided by the value investor. Our long-term outlook mitigates most of the psychological risks associated with sudden market falls. We should care not a jot what the stock market does in the short term, providing we've selected our stocks intelligently using all the values of our craft. Sanity will return to the markets sooner or later, and we may well be presented with an attractive opportunity to buy more stock whilst they're available at depressed prices. In regard to the risks of using debt to magnify returns, I'm sure none of us will be foolish enough to entertain stuff like CFDs, and if you are, then you've clearly tuned into the wrong podcast here. But even borrowing money in a careful and intelligent way is nearly always best avoided. The value investor's biggest strength should be our mental resilience, brought about through a deep understanding of Mr. Market's mind. On Black Monday, Mr. Market was in one of his foulest frames of mind, convinced the world was coming to an end. But we all know how his moods play out. Before too long, he'll be ecstatic once again, pushing stock markets to ever new highs. On that, we shall draw the episode to a close. If you've enjoyed it, I'm glad, and you can repay the favour by a simple act of adding to playlist. That way you'll be reminded whenever I've got something new for you. If you've not done it yet, please do it soon. You won't regret it. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.